Introduction to Cash Flow Projections. Contents. Introduction to Cash Flow Projections. Why accurate cash flow forecasting matters. Key components of cash flow. Methodology, direct versus indirect forecasting. Data collection and source reliability. Analyzing historical cash flow patterns. Predicting future cash inflows. Forecasting cash outflows and expenses. Handling seasonality and market volatility. Scenario analysis and sensitivity testing. Common pitfalls and how to avoid them. Conclusion and best practices. Introduction to cash flow projections. The lifeblood of business. Cash flow is the movement of money in and out of your business. Understanding it ensures you have enough liquidity to survive growth and meet your financial obligations. Projections versus actuals. While actuals look backward, projections look forward, allowing management to anticipate shortfalls and surpluses to make strategic, proactive decisions. Why accurate cash flow forecasting matters. Informed decision making. Accurate forecasts enable businesses to plan capital expenditures, hire new employees, and secure funding with confidence and clarity. Risk mitigation. By identifying potential cash deficits months in advance, management can take preventive actions such as securing lines of credit or reducing discretionary spend. Key components of cash flow. Operating activities. The primary source of revenue generation, including cash received from customers and cash paid to suppliers and employees. Investing and financing activities. Investing includes asset purchases or sales, while financing covers cash flows from borrowing, debt repayments, and equity transactions. Methodology, direct versus indirect forecasting. The direct method constructs the forecast by tracking actual cash receipts and disbursements. It is highly detailed and best suited for short-term planning. The indirect method starts with net income and adjusts for non-cash transactions and changes in working capital. It is ideal for long-term strategic planning. Data collection and source reliability, garbage in, garbage out. The accuracy of your cash flow model relies entirely on the quality of your inputs. Consistent collaboration with sales, procurement, and HR is essential. Establishing reliable sources. Utilize verified data points from ERP systems, CRM pipelines, and historical payment behaviors to build a robust and dependable baseline. Analyzing historical cash flow patterns. Finding the baseline. Reviewing past bank statements and cash ledgers helps identify the baseline operating costs and recurring payment trends unique to your organization. Identifying trends and circles. Look for historical correlations between business events and cash cycles, such as average collection periods for receivables and payment terms for payables. Predicting future cash inflows. Sales pipeline integration. Incorporates sales pipelines while applying realistic probability weightings to ensure forecasts are not overly optimistic. Customer payment habits. Do not assume invoices are paid instantly. Base inflows on actual average days sales outstanding, rather than theoretical payment terms. Forecasting cash outflows and expenses. Fixed versus variable expenses. Map out fixed commitments like rent and salaries alongside variable expenses that scale directly with production volumes and sales efforts. Timing of large capital outlays. Schedule one-off costs, pay tax payments, and capital expenditures precisely to avoid unexpected liquidity crunches. Handling seasonality and market volatility, accounting for seasonality. Many businesses experience seasonal peaks and valleys, build dynamic buffers to survive the dry periods using surplus accumulated in high seasons. Navigating market volatility. External factors like inflation, supply chain disruptions, and changing consumer habits must be continuously monitored and integrated into models. Scenario analysis and sensitivity testing, preparing for the unexpected. Develop multiple scenarios, best case, base case, and worst case. This helps you understand how different business outcomes affect your cash balances. Sensitivity testing, isolate critical variables such as 10% delay on collections or a 5% increase in supplier costs to see which variables impact your cash flow the most. Common pitfalls and how to avoid them. Over-optimistic sales projections. Avoiding assuming 100% of pipeline opportunities will close on time. Apply historical conversion rates to maintain realistic inflows. Confusing profit with cash. Profitable business on paper can still go bankrupt if cash is tied up in inventory and unpaid receivables when bills come due. Conclusion and best practices. Regular reconciliation and updates. A cash flow forecast is a living document. Update it weekly or monthly, comparing actuals to projections to continually refine your accuracy. Action-oriented insights. Use the forecast outputs to drive strategy. If the forecast warns of tight cash ahead, adjust your payment terms, delay investments, or secure credit immediately. Thank you.